This week I was working on a financial plan for a client of mine, and I realized that when I was digging into the numbers a little bit, that one seemingly small decision actually left them with a $1.9 million difference, depending on whether they chose one way or the other way. That small shift was the difference between withdrawing from an RRSP first or the TFSA first once they got to retirement. So let's check it out. Okay, before we go too much into the details of what we're looking at right here on the screen, just a little bit of background on the clients here. Obviously, I'm going to protect their privacy and their exact situation, but they would be in their early 40s and they're planning to retire right around 60. And the critical piece in their situation is that they would be what I call a super saver. So they're saving like crazy. And so they project to have more than enough saved to fund their retirement lifestyle. And so we would anticipate them passing away with some money to leave to their kids. In their case, they have enough RSP room and TFSA room to be able to save aggressively with those. And because they've got in the ballpark of 20 years to go from their retirement date, they won't need to save any more into, say, a non-registered account or anything like that. So when they retire, we anticipate them having just that combination, pretty straightforward, of RSP and TFSA. So I guess this is the $1.9 million question of where should they withdraw their savings from first. So when it comes to retirement, you got to live off something. And so if you've got TFSAs and RSPs, it seems like maybe a bit of a toss-up, but as we can see, it actually makes a massive difference which one you decide, and it all depends on your situation. So this is not universal advice because I'll show you in a second a different scenario that plays out slightly differently than this. Okay, so in their case, what we would be trying to do is maximize the estate worth at the end of the plan, and by doing that, we are accounting for estate taxes and fees that would be present potentially. Okay, because again, like I said, in their case, they are not projecting to spend all of their assets during their life, and so they would want to maximize whatever they can leave to their kids. So how can they do that? So in this case here, 2072 is the end of their plan, and if we're looking at the estate worth at that date, by withdrawing from that green section there, you can ignore some of these because we don't have bank or non-registered investments here. So that's why a bunch of the numbers look very, very similar. But the first one there of registered first, then non-reg, and then TFSA, that leaves them with the highest net worth at the end of their plan. And the difference is, if we round up a little bit, $1.9 million. If we do the inverse, if you take a look at the bottom section where you go TFSA first and then registered plans after that. So why is that the case? There's a few details that really matter here and make all the difference in this circumstance. A big one is that they've got enough time and enough cash flow to really invest aggressively into their TFSA. Plus, they've got a matching program at work, so their RSP balances are going to grow pretty aggressively, but they also still have cash flow to invest in their TFSAs. The benefit here between now and their retirement date is time. And so they're going to have a great combination of those two where there'll be meaningful amounts in either one of them. So the impact of a decision of one way or the other really, really matters. The reason this one does so much better by spending the registered money first and leaving the TFSAs last is that in their case, based on how much they need to spend to fund their lifestyle, they don't actually project to even touch their TFSAs because they won't have to. They'll be able to live off government benefits of CPP and OAS, plus withdrawals from their RSP. So if we push out the TFSAs as long as possible, the TFSA is actually a really, really great estate planning tool for exactly this reason. The money can go through your estate and you can name your kids as beneficiaries of the plan, and it bypasses both probate and any sort of income taxes that would be applicable on the money. Whereas in the other instance where they're spending the TFSA first and they're leaving the registered plan, so that's the RSPs in this case, till the end, they're still able to fund their lifestyle. They won't run out of money, but the amount that they'll be able to leave the kids is meaningfully different once we've accounted for the taxes. So the way that an RSP works upon death is that if you have a spouse, you can roll it over to them on a tax-deferred basis. So there's no tax implications if you're married and you pass it on to your spouse. But then upon the second death and you don't have a spouse to roll it over to, the full amount that's remaining in the RSP, or it's probably a RIF at this age, I guess, the amount that's left in the RIF counts as income in the year that you pass. And so in this case, because they have so much saved, if we're kicking that can down the road even further and that pre-tax amount can keep compounding, and this problem, it's great to have lots of money, don't get me wrong here, but as it keeps growing and growing and growing and they're not spending it, if and when they eventually pass away, the remaining amount in those accounts will be taxed at a much higher rate because it's all included in their income in that year. So say you have $1 million left in a RSP or a RIF when you pass away. In most provinces, the marginal tax rate on that amount of income is pretty close to 50%. So that's where a big chunk of this money ends up going by leaving the RSPs and RIFs until the very end. Another unique instance in their plan here that makes this a little bit more glaring based on the details of how they're willing to fund their retirement income is that they're willing to defer CPP until age 70. And so what happens in their case here, because we've decided to withdraw from registered first while deferring CPP, they're going to spend down a much larger chunk of that registered money. And then once age 70 comes around, because again, they're going to retire at 60, they've got 10 years where they're going to spend down their RSPs, then a much higher guaranteed amount of CPP kicks in. And so they don't even have to withdraw nearly as much of their remaining RSPs. Yes, they're going to have minimums that they have to take out, but it's going to be a much smaller balance because they've been withdrawing from them quite aggressively for the previous 10 years. So in that way, they don't have to withdraw nearly as much from their overall portfolio because they did that quite aggressively at the front end. Then the CPP kicks in at age 70, and then they can spend much, much less from there on. They also have a much higher backstop of guaranteed income if for whatever reason they had much higher expenses than they anticipated during those later retirement years. Okay, but like I said, this isn't always the case and it is very situational. So let's take a look at a different situation where the opposite might be true. Okay, so here's a situation where this couple is very, very similar in terms of their current age, even their target retirement date. They're saving in a similar way of doing both TFSA and RSPs, but their spending needs are different, their willingness to defer CPP is different, and their total balances that they would anticipate, that could be for a variety of reasons, even their willingness to take risk with their investments is different. And so in this case here, we actually, instead of seeing a situation where the difference keeps growing and growing and growing, there is a situation where there's a crossover here, and depending on when you pass away, again, you tell me when. No one knows, but we can try to look out into the future and anticipate and try to make as good of a decision as we can. But there is a bit of a crossover here in terms of the benefit over the long term as to which accounts you should withdraw from first. So if we go out to the very end of this plan, and if it goes exactly how it shows on the chart, which of course it never will, but in this case here, a very similar situation could show a difference of a little over $70,000 by withdrawing the TFSA first. And the reason here is because they're really, really close to getting to their target retirement number, meaning the amount of money that they have invested in their name to fund their lifestyle. And so when they're really close and you're probably going to spend most of your money during your lifetime, by spending the TFSA first and pushing out the RRSPs and the RIFs a little bit longer, you get the benefit of the pre-tax amount compounding for many more years. And because you're anticipating to spend that money during your life, the issue of passing away with a large RSP or RIF balance doesn't really matter in terms of the estate taxes, because if you're going to spend your last dollar on the day that you pass away, again, of course it never happens and we don't really plan for that, but just like hypothetically speaking, that would be a much more efficient way to go because of that added benefit of the compounding of the pre-tax amount on the RSPs and the RIFs. So I could drum up a number of different situations here. I'm sure you can figure that out. But depending on your situation, the impact of the withdrawal order of your investment accounts really, really matters. One of the critical aspects of both of these scenarios and most successful retirement plans that I'm seeing right now is that combination of RSPs and TFSAs. So if you don't have a TFSA yet and you want to maximize your retirement, check out this next video for reasons why I think everybody should have a TFSA when they retire.